Welcome to the week that was. We're diving into, well, a really intense period in the market, just full of friction. It
Yeah,
felt like short-term chaos on the surface, but then underneath, you had these long-term fundamentals sort of quietly building.
absolutely.
A week with, massive price swings, definite institutional panic, but also this real structural strength showing up.
It was more than just a tough week, I think. We're calling it the Great Divergence
Okay.
because you literally had this technical and, frankly, psychological collapse driven by all that leverage,
Hmm.
smashing headlong into, well, long-term structural validation. Think major infrastructure deals happening almost simultaneously. And the big drama, of course, was the market grappling with and eventually breaking that key $100,000 level.
Right. So that's our mission today, really. Let's try and unpack these forces pulling in opposite directions. What was dragging the asset down, all that selling, the liquidations, the
Yeah,
fear.
the visible stuff.
Exactly. And then what was building that foundation underneath all the noise? Those big infrastructure announcements, new corporate interests, maybe some regulatory clarity moving forward.
Let's start with a breakdown, the technical side, and how leverage just poured gasoline on the fire.
Okay. Where did it begin?
Well, it started pretty fast. You had that weekend rally, remember? Prices briefly poked up towards $111,000.
Right. Felt optimistic for a moment.
It did. But then momentum just evaporated.
Mhm.
Price fell back below $108,000, and that shift in momentum, well, it got amplified immediately by the derivatives market.
The leverage flush.
Exactly. A
Right.
really severe forced deleveraging. Reports showed up to, what was it, $536 million in leveraged longs getting liquidated, just wiped out in a cascade.
And that cascade wasn't random. It hit specific weak points, technically speaking.
Precisely. The most critical one, technically, was breaching the 200-day moving average, the 200-day MA.
That was around $109,000, right?
Yeah, just about 109K. It was holding a support, and for technical traders, that line is kind of the medium-term trend decider. Losing it tells a lot of people the outlook's flipped from bullish maybe to bearish
Okay, so that level flips.
immediately. 109K goes from floor to ceiling, basically.
Sure.
Major resistance. But the real fireworks, the real volatility happened as we got closer to $100,000.
The big round number, you mentioned the psychology of it.
It's huge. Analysts pointed out that something like 40% of all exchange orders, stop losses, limit buys, everything were just clustered right around that 100K figure.
Wow, 40%.
Yeah. So when the price finally, even briefly, dipped below it, bang, it triggered this massive chain reaction. Psychological fear became automatic selling.
And didn't some high-profile traders kind of amplify that pressure? I think I saw Peter Brandt.
That's right. Veteran
Right.
trader Peter Brandt, yeah. He publicly said he'd taken a short position, and he pointed to a specific chart pattern he called a megaphone, or a broadening top.
Okay, for listeners maybe less familiar with chart patterns, what does a megaphone usually signal?
It's generally seen as a dangerous pattern. It basically shows volatile indecision. The price swings get wider and wider, up and down.
Okay.
Brandt's take, looking at history, is that this kind of extreme volatility often resolves downwards, violently.
So technical breakdown, leverage flush, bearish patterns. What targets were analysts watching as things unraveled?
Well, that $107,000 level became the immediate resistance to watch. If the market can't get back above that soon,
Then what?
then you have several different models, sophisticated ones like the bear flag pattern, Elliott wave counts, even an unfilled CME gap down below. They all started pointing towards the same critical support zone, roughly between $92,000 and $94,000.
So a potential next stop if 107K isn't reclaimed.
That's the consensus, technically speaking.
Sure.
Pretty bearish unless 107K is taken back, and quickly.
Okay, let's shift from the charts, the technical chaos, to the actual behavior, the money flows.
Hmm.
This brings us to what you called institutional panic versus the whale civil war.
Right.
Let's start with the panic metric. The U.S. spot Bitcoin ETFs, that looked pretty bad.
It was rough. 6 straight days of net outflows. 6 days.
And until
Accumulated to over $2.04 billion walking out the door institutionally. That's the second worst streak they've ever had.
2 billion out, that's a huge chunk of demand just vanishing.
It really is a massive source of short-term demand, gone.
Mm.
But what's fascinating, though, is what happened right after.
Oh.
Right after that 6-day bleed. Boom. One single strong day of net inflows. $240 million came in, led mainly by Fidelity and ARK Invest.
Interesting. So not just random buying.
No, that looks like what we'd call conviction money. It suggests the long-term allocators, the strategic ones, saw the panic selling as a chance, an opportunity to buy the dip.
Okay, but conviction is one thing. Was that inflow sustained? Or was it just a brief pause in the selling? Because relying on these quick institutional dip buys feels like swapping one kind of centralized risk leverage for another, right?
That's a really sharp point.
Mhm.
And unfortunately for the bulls, no, it wasn't sustained. That initial inflow, that $240 million pop, short-lived. Aggressive institutional outflows kicked right back in afterwards. Another $558 million heading for the exits, led by pretty much the same groups.
So still nervous then?
Deeply cautious, yeah. It shows that while there is long-term conviction money waiting, the overall institutional mood is still very jumpy, highly reactive to price drops and, broader macro signals.
And this internal conflict, this nervousness versus conviction, you said it's mirrored in the on-chain data, the whale civil war.
Perfectly mirrored. It looks like a real generational transfer happening. On one side, you've got the old money.
The long-term holders, LTHs.
Exactly. Wallets that haven't moved coins in, say, 7 years or more. They were distributing, selling. Analysts are calling it fatigue.
Fatigue. Why now?
Well, over the last month, these LTHs distributed something like $45 billion worth of BTC. What's unusual, the deviation, is that they were selling into the weakness. Usually, they might take profits during rallies.
Oh.
Selling into a falling market suggests some longtime believers are just tired. Tired of the volatility, maybe reducing their exposure.
Okay, so old money is selling, but who's buying? The new money.
Precisely. In direct contrast, you have this cohort of whales, the ones holding between 30,000 and 10,000 BTC, often seen as institutionally aligned.
Right.
They were accumulating heavily, added roughly 30,000 BTC just in the last week.
30,000, while the ETFs were bleeding.
Yeah. So as the older, maybe fatigued holders are selling, this big institutionally connected cohort is stepping in, absorbing that supply. It really does look like a generational wealth transfer playing out right now.
Okay, so you have huge selling pressure, ETFs outflows, old holders selling, met by huge whale buying. What does that do to the average investor caught in the middle?
They capitulate, predictably. The crypto fear and greed index, it cratered, dropped down to 20. That's deep in extreme fear territory.
And that retail fear,
Right.
it serves a purpose.
It does, unfortunately for them. It provides the buy-side liquidity, the shares that institutions need to accumulate or exit positions. Remember, even with those big outflows, institutions still hold around 25% of the circulating supply overall. They use these panic moments pretty effectively.
All right, let's pivot. Away from the short-term panic, the fear, the selling, and look at that foundation you mentioned being built. The fundamental news that came out while the price was tanking tells a really different story, especially this AI pivot by the miners.
Yeah, this is potentially a massive structural shift for that sector. The big headline was cipher mining.
What do they do?
They signed this huge 15-year lease agreement with Amazon Web Services, AWS, valued at roughly $5.5 billion.
Billion, with a B.
With a B. Cipher is going to provide 300 megawatts of data center space. But here's the key, specifically for AI workloads, starting in 2026.
Okay, $5.5 billion, that's got to change the game for miners. How does this infrastructure 2.0 idea make them less risky, less tied to Bitcoin's price swings?
It's pretty straightforward, really. It gives them long-term, contractually guaranteed revenue denominated in fiat currency, dollars in this case.
Predictability.
Exactly. It basically repositions these miners. They're not just volatile Bitcoin proxy plays anymore. They become stable digital infrastructure providers, more like, utility companies.
That makes sense.
And that completely de-risks the sector in the eyes of traditional investors, especially infrastructure and energy funds, who crave those predictable cash flows.
Yeah.
And it wasn't just Cipher. We saw HIV Digital making similar moves, securing land for data centers to power 10,000 GPUs. This diversification, it's becoming the industry standard now.
So that's one pillar, miners becoming infrastructure players. What was the other structural support you mentioned? Corporate adoption, but not the big guys.
Right, not just the micro-strategies. This was about small to medium businesses, SMBs, quietly getting involved.
What did the data show there?
It was a fascinating report. Turns out something like 75% of businesses using Bitcoin have fewer than 50 employees. And they're allocating, on average, about 10% of their net income to Bitcoin as a treasury reserve asset.
10%? That's quite a bit for small businesses.
It is, and it adds up. This quiet, kind of sticky demand from the operational layer of the economy resulted in $12.5 billion in business inflows just in the first 8 months of this year.
12.5 billion, how does that compare?
That actually exceeds the entire amount from the previous year. And this kind of flow from operational businesses is probably less likely to get shaken out by market panic compared to, say, ETF flows.
Okay, strong fundamental shifts. What about regulation? Any progress there supporting the long-term view?
Yeah, a couple of significant moves aimed at making the market easier for big players to navigate. Over in Europe,
Mm-hmm.
the European Commission is planning legislation to centralize the supervision of digital assets under one single pan-European body, basically expanding the powers of ESMA, their securities regulator.
So like an EU-wide SEC for crypto?
Essentially, yeah, a unified framework across all 27 member states that standardizes the rules, makes it much simpler for large institutions to enter the market across the whole block.
Okay, that's big for Europe. Anything else?
And over in Asia, Hong Kong continues its push to be a major hub. Their regulator, the SFC, announced they'll now let licensed crypto trading platforms connect with their global affiliate platforms.
What does that achieve?
It lets them share order books. The goal is specifically to tackle the problem of shallow liquidity pools in Hong Kong, give local investors better price discovery, tighter spreads, make it more efficient.
Got it. Okay, let's bring in the outside world now. Macro headwinds. The broader stock market, particularly tech, had a rough week too, didn't it?
It did. The Nasdaq had its worst week since April, actually. And the selling was really concentrated in those AI darlings, NVIDIA, AMD, a lot to talk about, maybe frothy valuations there.
How did Bitcoin fit into that? Was it just following tech down?
That's the interesting part. Citi put out some analysis suggesting Bitcoin actually acted as a kind of canary in the coal mine, meaning Bitcoin started dropping before the big tech stocks really sold off. It suggests Bitcoin isn't just reacting to tech sentiment, but might actually be a leading indicator for global liquidity conditions. When money gets tight, Bitcoin feels it first.
Interesting perspective. And amidst all this selling and macro fear, we also saw institutions putting out wildly different price targets, the great forecast divergence.
Right. Kind of wild timing. You had JP Morgan coming out, setting a new target of $170,000.
Based on what?
Based on their gold parity model. Basically treating Bitcoin as a digital store of value, a direct competitor to gold, and valuing it accordingly.
Okay, $170 from JPM, but then Cathie Wood adjusted hers.
Yeah, Cathie Wood revised her famous 2030 target. She brought it down slightly, from $1.5 million to $1.2 million.
Still a huge number, but why the reduction? Is she less bullish?
Not on Bitcoin itself. According to her reasoning, she actually attributed the $300,000 trim to the success and rapid growth of stablecoins.
Stablecoins, how do they affect Bitcoin's target?
Her view is that stablecoins, which she projects could hit $2 trillion in market cap by 2028, are really capturing the medium of exchange use case, that payment function. And because they're doing that so well, it carves out a piece of the total addressable market that might have otherwise gone to Bitcoin. So Bitcoin is still the store of value, but maybe less of the payment rail in her updated view.
Fascinating. We also saw some strange action in the altcoin space, right? Some older coins rallying.
Yeah, the so-called Dino coins had a moment. Filecoin, FAL, for example, rallied quite sharply. It got reframed in the narrative as a key piece of decentralized physical infrastructure, DePIN, relevant to the AI sector.
Connecting to that AI theme.
Exactly. And Litecoin, LTC, another old-timer, rallied over 16%. What was driving that was apparently all-time high on-chain transaction volume, hitting like $15.1 billion. Real usage metrics spiking.
But not everything rallied. The big Solana ETF launch.
Classic sell the news. Despite a really successful launch week in terms of inflows, pulled in $421 million net.
Pretty good numbers.
Yeah, solid inflows. But the price of SOL itself dropped 20% over the same period. It shows the market is getting mature enough now to fully price in these big known bullish events beforehand, and then, traders sell into the actual announcement.
Okay, so after this absolutely wild week, conflicting data everywhere, institutional selling, but whale buying, minor pivots to AI, liquidations, macro pressure. What does the immediate future hinge on now? Where do we stand?
Honestly, it really boils down to the weekly chart close. Right now, the market is fighting tooth and nail to hold on to the 50-week simple moving average. That's sitting right around $102,970.
And if it doesn't hold?
Analysts are warning pretty loudly that a weekly close below that line would be significant. It'd be the first time since way back in 2023. And it would basically validate those more aggressive bearish technical forecasts we talked about earlier. Could signal a bigger trend reversal, potentially opening the door down towards that 92K to 94K zone.
So a really critical level to watch into the close. It really was a structural tug of war this week, wasn't it? You had this quiet powerful accumulation happening, the SMBs, the miners pivoting.
That's structural stuff.
Yeah. Battling against the very visible, very noisy institutional distribution through ETFs and that contagion effect from the broader tech sell-off.
Absolutely summed up. And as you think about this divergence, this push and pull, maybe the final thought to consider is about the underlying risk. In both systems, old and new.
Meaning?
Well, on the traditional side, we saw that New York Fed research practically confirming that their new solvency metrics could have flagged banks like SVB and First Republic as basically insolvent years before they actually collapsed. It just validates the idea that traditional intermediaries can be incredibly fragile.
Okay, fragility in the old system. But isn't the digital asset space, even with Bitcoin's core promise, getting more reliant on intermediaries too?
That's the crucial counterpoint. Yeah. Precisely. All this structural validation we celebrated, the ETF inflows, the big institutional money coming in, where does it mostly go?
Into custody solutions.
Right, towards centralized custodians. We now know that roughly 70% of all Bitcoin is held in custodial wallets. That's up from only 50% back in 2022.
70%. Wow.
Yeah. So while we cheer the institutional acceptance, the infrastructure deals like that $5.5 billion AI contract. We have to ask, are we gaining financial validation for the asset only to trade away individual sovereignty by amplifying custodial risk?
It just shifts.
It shifts. This growing centralization of ownership, especially when you combine it with the proven fragility of centralized financial intermediaries, well, it just means that understanding and maybe utilizing self-custody becomes exponentially more important as this whole cycle matures. That's the real tension, the question maybe you should be mulling over.